John Grant, dead guy, haberdasher. I don't know if you know what a haberdasher is. Haberdashers are people who make hats. He was alive in the 1600s in plague-ridden London, and he had a morbid preoccupation. He loved the Bills of Mortality. The Bills of Mortality was a weekly magazine that listed death. He took 70 years of the Bills of Mortality and created the first actuarial table. It was a big deal. Up until that time, people couldn't do things like answer the question, hey, what's the likelihood of living to 16? Or what's the chance of dying by 70? He was able to do that, okay? Now, he was a commoner in London. The king found out about John Grant and his morbid preoccupation and his actuarial table and invited him to join the Royal Society. Big deal. Royal Society was full of people with titles and powdered wigs and big buckles and things. He wasn't one of them. They didn't like him being there, and once the king died, they got rid of him, kicked him out. You're about to meet the modern, security-oriented John Grant, okay, by the name of Scott Stransky. I first met him 2 years ago. I was speaking at the Black Hat CISO Summit 2 years ago. He spoke then, and he spoke at the most recent one. The CISOs have asked for him to continue to present every year because the data and analysis he presents on loss, on insurance loss, right? So Marsh, who he works for, has probably the largest data set on this. He's going to come on and wow you, right? So I want to warmly welcome Scott Stransky to the stage. That's you, Scott. Come on out. All right. Thank you.
Thank you. Great. Yeah, thank you so much for having me. Great to be here. I'm glad everybody decided to come back after partying or who knows what everybody did last night. So I'm going to get into all the fun math. Who here likes math? A few people? Okay. Who here hates math? A lot of people. Okay, so I'll try to make the math a little bit fun. And to do that, I'll give you some cyber jokes. I like to do this to kind of liven the thing up, make sure you're all awake in the morning. So I'm going to start with a brand new joke that even Richard hasn't heard yet. I will end with my classic joke that apparently everybody loves the best. But I'm going to start with a new one that I've not really tried before, so we'll see what you all think of it. I was with my 94-year-old grandmother a few weeks ago, and we were talking about her computer. She's not very savvy on the computer. And I asked her what her password was and to make sure she had a strong password. And she said that her password was the word incorrect. And that was a little bit strange to me. I was wondering why in the world would that be the case. So I asked her, why did you have that as your password? Well, she told me because if she enters the wrong password, it'll pop up and say your password is incorrect. So there's a horrible joke. I have a lot more really horrible jokes. In fact, they only get worse from there. I got one person clapping. Okay, so my presentation is entitled Quantifying the Costs of Cyber Risk, and we have a lot of different topics to cover. First, we'll talk a bit about cyber insurance. I know we've talked about cyber insurance at this conference. Many of you may not know what it is. I'll give you a very brief overview of that. But then we'll get into the meat of this presentation, which is talking about the data that's available to the cyber insurance world. And then we'll get to the part that's actually most practical for you all. We've tried to correlate our cyber insurance incident data with data from various sources that you've seen, maybe questionnaire data, outside-in data. You've heard of BitSight or Security Scorecard. We've actually correlated loss data with those two products. And then dark web data. We'll show some examples of that. At the end, I'll try to make it more practical about how you can use this in your jobs as you go about your business. So first about cyber insurance. I think people find insurance to be a quote-unquote boring space. I don't think it's boring. There's actually a lot of very exciting things going on in cyber insurance. Cyber insurance has actually been around for many, many years. It's been around for a couple decades, but it's gotten more useful and more take-up over the past decade or so. There was something called a soft market back from 2015 through 2018. In fact, we're in a softer market now. That means for you all trying to purchase cyber insurance, it's relatively easy. There's fewer questions being asked of you. It's easier to get larger limits, broader coverage, fewer exclusions. But there was this period from, say, 2019 through 2022 where we were in what's called a hard market. And a hard market is the exact opposite. It means it's actually very difficult to get insurance. There'll be more questions, lower limits, higher prices for insurance. And that was really due to ransomware. As ransomware took off in 2018, 2019, 2020, cyber insurers realized they weren't getting enough premium, and they weren't able to necessarily afford to pay out all the claims they were getting, so they had to raise their rates. And in fact, in many cases, they doubled their rates between 2019, 2020, and 2021. Though, again, we've seen this soften over the past couple years. Since 2022, rates have come down. So this is actually a great time to buy cyber insurance if you haven't already done so. Very briefly, cyber insurance tends to cover the things that you're most worried about. For example, data getting stolen, the costs associated with that. Business interruption, if your network is down, they can help you recover from that. And also ransomware. Many cyber insurance policies will pay a ransom extortion demand from the bad actors. In fact, they'll even help you negotiate with the bad actors. So where are we today for cyber insurance? Well, it's actually a pretty good market for you all buying cyber insurance. If you haven't bought it already, I think this is a great time, and I'll give you some examples of why this is a good thing to do. I know at this conference there's a lot of talk about mitigating the risk, which is one of the things you can do to help for cybersecurity, but transferring the risk away really goes in conjunction with mitigating the risk. So I want to get through all the boring stuff first. This is just the rate changes over time, and you can see back in 2022 at the beginning of the chart on the far left, that rates were increasing dramatically year over year. So if you were buying a renewal of your exact same cyber insurance policy, you'd be paying 20, 30, 40% more than you did the previous year. Now you see it's actually slightly negative, meaning for the same policy you bought last year, you're going to be paying just a little bit less on average than you paid last year, which is great. So I wanted to talk very briefly about cyber insurance just to make sure everybody at least knows what the concept is. But now I want to get into the fun part, at least the fun part for me, which is talking about cyber data and how that can be used by you all in your work. So there's a lot of different types of cyber data out there, and we think of it as a kind of spectrum. And the spectrum starts with firmographics. This is the basic information about your company. Things like your revenue, your industry, your employee count, where you're geographically located. Things that in many cases, especially if you're a public company, you can determine online for free. But if you're not a publicly traded company, this is actually quite important. Now, I'm not going to show you any results here, but we've built very basic cyber models with just your industry and revenue, and you get most of the way there. It doesn't refine you versus your peers, but you versus other companies that are in different industries and revenue bands. It actually gives you a pretty good idea of how much more or less risky you are than those folks. So firmographics really form the basis for any cyber data exercise that we're going to think about. Then we get to incident data. Now, this is an area where we in the insurance world think we have great data, and I'll show you that on the next slide. But you may have data about your own incidents. You probably don't have data about your peers, your competitors, other industries, and so forth. This is where insurance claims data becomes quite critical. There are also some claims data sets that are available for license online, but these are really biased. These are really from public web scraping of media sources. They're from Freedom of Information Act requests and other things. So they tend to be biased towards US-based companies. They tend to be biased towards larger companies. They tend to be biased towards publicly traded companies which have maybe an obligation to report a cybersecurity incident. Again, we'll talk more about why insurance data doesn't have those biases in a moment. Then we get to outside-in data. And I mentioned BitSight and Security Scorecard earlier. I'm sure many of you use some of these outside-in scanning services. Many of you also may think, oh, they're snake oil. They're garbage. They have no use at all. Forget it. I'll talk a bit about those in a few moments. What I will say is the cyber insurance world, in some cases, relies upon these, maybe more than they should. I don't want to spoil what I'm going to show you in a few moments. There's also dark web data, which can be received from the outside. Again, you don't need permission from a company to go in and do this. And I'll show you some examples of where we've worked with dark web vendors to correlate what's seen on the dark web with subsequent cyber insurance losses, meaning breaches. Then we get to inside-out data. Here we obviously need your permission to do this, and this comes in a few different shapes as well. First are questionnaires. Anybody here who's applied for cyber insurance has probably filled out a lengthy questionnaire. You're probably thinking to yourself, these questions are kind of silly. They're not getting into the depth that I would want to get into as a CISO or a cybersecurity professional, yet we have to fill out all of these things. I'll explain about those in a moment as well and how those correlate with losses. And there are also scans. Nowadays, you can install things within a company's network, get inside telemetry, sort of like you do for telemetrics with cars, and start to use that for cyber insurance. I don't have any slides on that here because we haven't done any correlation studies between that and insurance losses yet. But what I will say is there are some cyber insurance carriers who are offering discounts if you do this. Even if the data is bad, they don't care. They just want you to do it and give them the data, and they'll give you 15% off your cyber insurance. Again, it's something to consider if you're willing to share this type of data with your insurance carrier. And this brings us to loss modeling, which is the far end of the spectrum, and it puts together all of these other features into a cohesive model that can be used to estimate your financial consequence from various cyber incidents. And we'll talk about those as we go through this presentation. But first, really the question is, why insurance data? You all may be thinking, oh, insurance data, it's kind of silly, who cares about insurance? But think about it, if you've purchased insurance and you suffer an incident, you're probably going to want to tell your insurance carrier that you had this incident to collect your payment. Therefore, this gives us a much more unbiased data set than really anything else out there. It's a smaller universe. We don't have the universe of all companies. We only have the universe of companies who have purchased cyber insurance. But for those who have purchased cyber insurance, we believe we have a super comprehensive data set of those companies who suffered a cyber insurance incident. Now, we see about 5% of the companies that purchase cyber insurance have a claim or suffer a cyber insurance incident in the next year. So I actually want to debunk a common myth that we hear from a lot of these cybersecurity vendors. They call me all the time. Believe me, I get calls from vendors almost every day, and I'm willing to take them because sometimes you find the diamond in the rough. But one of the things I hear is, oh, our model is 85% accurate, or our model is 90% accurate. And I'm thinking to myself, what does that actually mean? I could build you a 95% accurate model in 2 seconds right now. It basically says, no, you will not have a breach. Remember, I said only 5% of companies had a breach. So for 95% of companies, it'll be an accurate model. It's also a stupid model, absolutely ridiculous, but it's a 95% accurate model. So you have to take these things where companies say, oh, we're 95% accurate or 80% accurate. Take them with a lot of salt, not just a grain of salt, a lot of salt. You really have to understand, what do they mean by that? Again, I just showed you how I can build a stupid model that's 95% accurate. Absolutely useless, but it's 95% accurate. So that's another reason that we want to get into the data and separate the useless from the useful. Cyber insurance data is also global. When you think about Freedom of Information Act requests, those are mainly for US companies, but cyber insurance is a worldwide phenomenon except for sanctioned countries. And there is a high fidelity in reported incidents. So we learn things about these breaches that companies do not want public, and in fact, we do not make them public, but we know about it because we're trying to pay out the claim, we're helping them get the claim paid out. So we have a lot of information about why the breach happened, perhaps some of the mitigation things that were in place that did or did not work. So that's why cyber insurance data is a great data set to use for building cyber insurance analytics. So I know there's a lot going on here in this chart, but this is a bit about the overview of cyber models that exist. And they fall into two main families. One that's called deterministic cyber modeling. This says, if an event happens, here's how much it might cost you. So for example, if you have a DDoS attack against your network, here's how much it'll end up costing you. But then we have probabilistic models, which says, how likely is this thing to happen? And how much will it cost you? And that likelihood allows you to understand, well, okay, this could be a $10 billion event or a $3 million event. But if it only happens once every 1,000 years on average, or once every 10,000 years, maybe it's not something you want to worry about. Whereas if it's something that happens every other year on average, it's much more critical to your business. Now within probabilistic models, we have things called attritional models and CAT models. Attritional models, this means loss from day-to-day events that impact your company only, whether it's a ransomware attack against you, a business interruption event, etc. CAT, this is not the animal cat, although within our company we always use cat memes and all sorts of things. This stands for catastrophe. It's a catastrophe model. This is looking at aggregation events, things like Amazon Web Services failing and taking down lots of companies with it, or some other cloud, or a payment processor, or a DNS provider failing and taking down many companies at once. These are what we call CATs. We had CrowdStrike earlier this year. That's along the lines of a CAT event, where CrowdStrike is that single point of failure, taking down a bunch of other companies with it. Now on the attritional side, as I said, we can split it into many different things like ransomware breach and business interruption. The CAT side can also be split into various categories such as cloud or mass breach or a power outage or many other things there too. I only want to spend one moment on CAT models because I really want to get into some of the data that we've looked at. But I did want to compare cyber CAT model losses to model losses from other perils. So hurricane is here on the left. Obviously, we've just experienced a hurricane in Florida. There are a lot of insurance models out there for hurricane risk. And I'll explain what's going on in this chart in a second. Then we're looking at severe convective storm with thunderstorms, winter storm, earthquake with fire following, terrorism, and cyber. And one of the concerns we get with cyber models is, oh, your tail risk, your 1 in 200 loss is quote unquote too high. And I asked the client that we're talking to, why do you think it's too high? We've had maybe 10, 15, 20 years of cyber experience. What justification do you have to say that a 1 in 200 type loss is too high? And they usually go quiet. They don't really have a good answer for that. It's usually, oh, my 30, 50, 80 years of cyber experience. And I'm like, okay, fine, but cyber hasn't really been around that long. So what we've done here is compared other perils to cyber. Now first, the width of the bar shows the divergence between the various models that exist. So there's a lot of models for hurricane, but it's a very narrow bar for hurricane. There's very little divergence in hurricane model risk. The height of the bar shows the relativity between tail risk and expected risk. So the expected risk, the average annual risk, the mean risk, this is what you can expect to see in a given year, whereas the 200-year return period risk, there's a 0.5% chance that that will happen in a given year. And we can see for hurricane, it's about 12, meaning we think the tail risk, the really bad event, is about 12 times worse than an average year. For severe thunderstorm, it's way down there, around 2. So the worst severe thunderstorm year is not going to be that much worse than an average year. Earthquake with fire following is actually the worst of these perils that we're looking at, which I think makes sense. Because if an earthquake were to happen here in California or some other place, the loss could be much more extreme than an average year, which typically doesn't have any earthquakes at all. And then we get to cyber on the far right. We can see it's a pretty wide bar. The models have some divergence, but it's not as high as earthquake, meaning the very worst type of event for cyber compared to a typical event for cyber isn't as extreme as it would be for earthquake. I don't know if this makes people feel better about cyber risk or worse about cyber risk. It's just facts and data for you all to use as you're managing your risk. I'm not trying to say, oh, wow, cyber's so bad compared to hurricanes. That's not the point of this. It's really to give you information to arm yourselves that, wow, we've seen average events that happen every few years, but it could be, in this case, up to, say, 20, 25 times worse than an average year. Okay, let's talk about cyber controls. This is a little bit more practical for you all, not thinking about the extreme tail of risk. Now with cyber controls, as I mentioned earlier, we have a data set with hundreds of questions that people fill out as they're looking to acquire cyber insurance. We have this for thousands of clients, and for those same clients, we know whether they had a cyber insurance loss. So we wanted to do a study to correlate the answers to these questions with whether they had a cyber insurance loss. To do this, we had 4 steps. The first step was determining whether the claim was malicious or not. If somebody left a laptop behind on the train, not malicious, we didn't want to account for that in this study. Then we did a little bit of math, and I did mention math at the beginning. There's a tiny bit of math here. We determined the probability that you have a claim given that you said, no, I didn't implement this control. And in parallel, we determined the probability of a claim given that you did implement the control and divided those two things. This gives us what we call a signal strength. So you can imagine if the signal strength is quite high, this control matters a lot. So if the signal strength, say, is 5, that means you're 5 times more likely to have a cyber insurance loss if you don't do this thing compared to if you do. If the signal strength is 1, it means that this control has almost no impact at all. And if the signal strength is below 1, it actually is counterintuitive. This control may actually have the opposite impact than what you'd expect. So I'll give you a few examples before I show you some results of why we can't just trust the data alone. And I will show you some actual data results on the next slide. I'll also mention this is in a publicly released report. I have a QR code at the end that you can scan. You're welcome to take photos of the slide as well, but I'll give you a QR code at the end so you can actually get these reports. They're all public. I'll give you a few examples, though, why we can't just trust the data entirely. So remember what signal strength means. We got a signal strength of 0 for one of the questions. I'll tell you what the question is, and then I'll tell you why, obviously, this is ridiculous. So we have a question in our questionnaire that says, do you have physical security around your servers? That actually came out with a signal strength of 0, implying that you should never have physical security around your servers. Obviously, we thought this was a little strange, so we wanted to investigate what was going on. It turns out only 4 out of our thousands of clients said no, they don't have physical security around their servers. None of those 4 had a cyber insurance loss in the years that we looked at. So that implies, if you do this math, that it's better not to have physical security around your servers. Obviously, that's absolutely ridiculous. Please don't think that's the intention of this study at all. So in fact, that's excluded from our study. There just weren't enough data points for those who don't have physical security, which is great. Again, I'm not suggesting you go unlock all of your server rooms as soon as you get back to your office. That's not at all what I'm suggesting. We actually saw something the opposite way, too. One of the things with the highest signal strength had a signal strength, I don't know, maybe 5 or 6. But we also didn't include it in the study because it was a question about having good logs. The question was something very specific about logs. It was like, we maintain good logs about our servers or whatever it was. And I'm thinking to myself when I look at this, we don't want to imply that all we have to do is have good logs and now we're safe. That's also a terrible thing to imply. So while the signal strength was good, it's not because you have logs. Having good logs is a proxy for other good cyber culture and other good cybersecurity things. So that's also not included here, because we do not want you all going back to your office and be like, oh, throw out all of our cybersecurity stuff, let's just have good logs and we will never have an incident. Definitely not the case. So here are the top 5 things. There's a lot of words here. Again, you can take a photo of it, but I'll give you a QR code which will have the study link itself. The number one control that we found was about hardening of your Active Directory. Specifically, our system configuration management tools enforce and redeploy configuration settings to systems. Turns out 96% of our clients already do this, but for the 4% that don't, they have a 5.58 times higher likelihood of having a cyber insurance loss over the next year. So I'm expecting about 4% of this room to just leave now and kind of fix this. Nobody's leaving it. Well, I'm glad you all have done this. If you haven't done this, again, please, this is super important. And again, the data bears this out. This is from real cyber insurance loss data. You can see some of these other ones. I want to draw your attention to the bottom one on this slide. It talks about patching. And it's a very specific question about patching. It's patching vulnerabilities of CVSS 7.0 to 8.9 within 7 calendar days. You'll note it's not the 9.0s and aboves. It's specifically the second tier. The 9.0s and above do have a signal, but it's a bit lower than these top 5. You'll also note only 24% of our clients do this. So this is an area where you can improve and shine above your peers, have much more reduced risk than your peers. So we talked to our own CISO about this and tried to understand, well, why is this going on? Why is it so much more important to patch the second tier of vulnerabilities? And his thought was that the bad actors know this too, and they realize that the highest tier of vulnerabilities are going to be patched really quickly. They don't have a chance to get in. Whereas these second tier vulnerabilities are only patched by a quarter of our clients. The bad actors realize they can try to exploit them and get in. We did try other times besides 7 days. We looked at 3 days, 1 day, 50 days, 100 days, et cetera. 7 days was the most correlated with reducing your risk. So in this case, this is what we found, is that 7.0s to 8.9s, if you patch them within 7 days, you can drastically improve your cybersecurity posture and reduce the risk of having a cyber insurance loss. So this chart kind of brings all of those cyber controls together into a single handy chart. So what's going on here? Well, first on the x-axis, we see the revenue of a company, so you can figure out where your company lies here. And then you go up and you see what we call a modifier. What does that mean? Well, if you think about a base peer company has a modifier of 1, this shows where you sit compared to those peers. If you have the very best case and the very worst case, I mean, if you answer all the cybersecurity controls well or poorly, this is how much you could increase or reduce your risk. So think, let's say, about a $1 billion company, which is 1,000 million there. The bottom is about 0.8, and the top is just under 1.4. So what does this imply? It implies a lot of things. First, it implies that even if you had the very best cybersecurity controls compared to your peers, you're reducing your frequency of events by about 20%. Also, if you went from the very worst to the very best, you're still only reducing your frequency by maybe 40 to 50%. So this is a chart that you can take back if you ever do have an incident and be like, look, it wasn't our fault. We did everything we could do. There was still a chance of cybersecurity incidents. Great, but also not great. There are other things hopefully you're doing to make that blue line go down even further. For example, purchasing cyber insurance, transferring away some of that risk. And that's really where, obviously, Marsh comes into the picture as a cyber insurance broker. But the idea is, yeah, you could do only so much with your cybersecurity controls that there's residual risk. And that residual risk needs to either be managed, transferred away, or just accepted, I suppose, in some cases. Again, you can see here for smaller companies, having better cybersecurity controls makes a larger difference than for bigger companies on a percentage basis. Of course, on a dollars basis, a small percent from those big companies is actually a lot of dollars, so it actually does make a big difference in terms of dollars and cents. But I'll show you a couple more of these charts in a moment for other things that we've looked at. I want to talk a bit about vendors. We've looked at a lot of different vendors using our insurance loss data. We looked at outside-in vendors. These are your scanners like BitSight and Security Scorecard. And we also looked at dark web data. Again, I'll take a call from any vendor once, but if they're not willing to share their data with us to do this type of study, we don't license them, we don't talk to them anymore. And we've done a correlation study between their scores and cyber insurance incident rates. I'll start with BitSight and Security Scorecard, and then we'll talk about some dark web data. So there's a lot of stuff going on here on this slide. Again, these are public reports. With the QR code at the end, you'll be able to download these reports. On the left is BitSight, and the right is Security Scorecard, just for your reference. But what we're looking at here is a correlation coefficient. So I know a few of you raised your hand and you like math. If you're familiar with statistics, you may have heard of something called R or R squared. This is R, so you can square it and get the R squared. So what we're looking at here is the correlation. Negative is good, meaning a higher score equals lower risk. And we can see from BitSite, the BitSite patching cadence has an R value of about minus 0.32. So R squared is about 10%, if that means anything to you all. What it means is that BitSite patching cadence score is explaining about 10% of the variance in cyber insurance claims frequency. 10% is not zero. It's statistically significant, so it's definitely not zero, but it's also not 100%. So 90% of what's going on with your cyber insurance losses or cyber incidents in general is not explainable by these type of scores, but about 10% is. And you can see examples with Security Scorecard as well. Some of them are good, some of them are bad, but they're all there. Again, we have public reports where we did these studies. So my view on these scores is that they're okay, they're useful, they add some value, but if you're only using them to make decisions, you're probably not getting what you should be getting. I would say that to a cyber insurer as well. If this is all you're looking at when you're underwriting a risk, you're missing a whole lot of stuff. Same thing I would say to a CISO is that if this is all you're looking at, you need to do a bit more. That said, I would say these do have some value. They're not garbage. They're not snake oil. They do have value. A lot of times I talk to CISOs, they're like, oh, this is absolutely ridiculous. And in fact, one of the things that we see gives the biggest issues with these scores is the IP address footprint that they associate with your company. BitSite and Scorecard and all these vendors, the first thing they do when they're scoring you is they map IP address ranges to your company. They do that okay, but sometimes they mess up. Sometimes they associate IPs that are not yours with your company, or vice versa. And this is a problem, because then they're associating perhaps bad IP addresses with you, and that could reduce your score. So one of the things you can do with both BitSite and Scorecard is review the IPs that they've associated with your company, and that in many cases will actually fix, it's not really fixing your score, it's giving you a more accurate or an actual score for your company. Now, if you remember the funnel diagram from a couple slides ago, here's the equivalent one for these outside-in scans. The biggest thing to take away from this is that it's a narrower funnel. What does that mean? Well, it means it doesn't quite matter as much as the controls questions that I showed earlier, which I think makes intuitive sense based on what I've said, that there's some value here from these scores, but not as much as the cyber controls that I showed earlier. So here, instead of going from 0.8 to 1.4, it's going from maybe 0.85 to 1.3. It's a bit narrower of a funnel. Again, there's some value here, but not that much value. The last of these outside-in type of things that I'll talk about is dark web data. We recently worked with a dark web vendor to try to understand if seeing things on the dark web is indicative of then suffering a cyber insurance loss. There's a lot of stuff going on here on this slide, so I'll try to explain it as quickly as possible. We looked at 9 different places on the dark web for things about companies that we know about. We looked at things like credentials or forums, markets, Paste, Telegram, and more. And the first thing I'll say is just the fact that data was exposed, credentials were exposed, doesn't mean that your company has been breached. What it means is perhaps one of your employees went on a news site or a shopping site, they used their work email and password, not a great idea, and that company or that site got breached, and now those credentials are for sale on the dark web. So it doesn't mean you've actually had a breach yet. So there's actually time to fix these things, as you can see by what we show in the data analysis. Now we're looking at has finding versus Y versus N. So what does this mean? It means yes or no, did we find this company on the dark web or not? And then we see the insurance loss rate. And you'll see for every single one of these 9 categories, the Ys are higher than the Ns. This means if they found something about your company on the dark web, you always had a slightly higher chance of having a cyber insurance loss over the next year than if they didn't find something on the dark web. And it's statistically significant for those who like confidence intervals. The chart on the left shows that the confidence intervals do not overlap between the Ys and the Ns. We also see the sample sizes for each of these, so it's not like we're talking about a couple companies here. These are large sample sizes, lots of companies in each of these samples. There's also a few things that I wanted to point out, say for credentials. You'll note the sample size for Y on credentials is much larger than the sample size for N. Why is this? Well, it means most companies have their credentials out on the dark web, unfortunately. But it also means if you're one of the, in this case, 1977 that doesn't, you actually have a much more reduced risk, about half the risk that you would if you did have those credentials out there. The opposite is true, say, for Telegram. Here, the large sample size is for the Ns, meaning most companies are not being discussed by the bad actors in these very specific Telegram channels we were looking at. On the other hand, if it's Y, meaning you were being discussed, there you actually have a significantly higher chance. So there's actually 3 levels. There's kind of the baseline, there's a reduced risk, and there's an increased risk. And depending on which category you're looking at, it either increases or decreases your risk. So credentials would be an example where if you don't have it, it decreases. Telegram would be an example if you do have it, it increases your risk. And here's the funnel chart for this dark web data combined with the outside-in data. And you'll actually see it's the widest of the funnel charts. So why does this make sense? Well, it's because if your data is out there on the dark web, It's not controls that may or may not prevent an incident. It's not these outside-in scans that don't really see everything. Your data is actually out there for sale on the dark web. So it actually has the most impact of all of these things. But it is actionable. You can reset people's passwords. You can ensure that the bad actors who are talking about attacking you via this vulnerability, you patch that vulnerability. There are things you can do to prevent it. It's not a guarantee that you will have a loss or a cyber insurance incident just because things are out there on the dark web. Again, you can't get this all the way down to zero. You also can't get super high based on the results of this study. Again, we have a lot of these different charts. I like data, I like charts. I think this is a very interesting way to look at it. Again, this is great ammunition for you all if you ever did have a cyber insurance incident. It's not always your fault. Sometimes it's the CISO or the IT staff's fault. But again, you cannot reduce that risk to zero, regardless of what you do. And I think that's an important thing that this data shows, to arm yourselves as you're going in. Again, I'm not saying don't do your job because, oh, we can never get it to zero. You can get it low, but you can't get it to zero. And again, that's where either accepting the risk or transferring the risk with cyber insurance comes into play. So speaking of cyber insurance, here are the top 12 key controls that we have found that cyber insurers are looking for. Again, we're not a cyber insurer, we're a broker, so we help companies place their cyber insurance with the carriers, but these are the 12 things that they're looking for. MFA, EDR, etc. If you do all of these things well, you'll get broader coverage, higher limits, lower premiums, better terms and conditions from the insurers. Again, these are the 12 key things to do. One thing I'll point out here is multi-factor authentication. If you remember the cyber controls slide I showed earlier, you didn't see MFA amongst those top 5 controls. You may be wondering where it was. Well, we actually have 3 questions about multi-factor authentication in our cyber self-assessment questionnaire. Turns out each individual question doesn't have very much signal strength at all. But if you say yes to all 3 questions, then you actually get a substantial benefit and reduction in your risk. So that's an example where it's not just, oh, one question you have to say yes versus no. With MFA, even answering 2 of the 3 yes doesn't give you the benefit. But answering all 3, MFA for employees, MFA for administrators, and MFA for crown jewels, if you say yes to all 3, you actually get a substantial reduction in your risk. So I'm going to go to the next slide, which has the QR code in a second. I'm going to give you a cyber insurance joke, one more at least, and then we have a couple minutes for some questions from you all. So this is my favorite joke of all time. I don't know, maybe it's not your favorite joke of all time, but we'll see. So there's also a password joke. I was with a colleague the other day, and he was logging onto his computer, and he was typing and typing and typing his password. It seemed really long. So I asked him, why is your password so long? And he actually told me what his password was, which is, of course, terrible from a cybersecurity perspective. But he told me that his password was Snoopy, James Bond, Mickey Mouse, on and on and on, Sacramento. And I asked him, why in the world is that your password? And he said, well, they told me it had to be at least 8 characters and a capital. So there you go. That's my favorite cyber joke. So here is the QR code. So please do scan this. It'll give you a little form. It'll ask what event you attended. You just put Q or QSC. It'll ask for your name, your email address, and then there'll be a few options. You could either request a copy of these slides, the reports. I could give this presentation to your team, whatever it is. There's a few options. Please fill out the form. It takes like 2 minutes to fill out. So we have time for a couple questions from the audience. I always like to hear random questions from the audience. So please raise your hand if you have a question. If not, I have more cyber jokes. That doesn't mean you shouldn't raise your hand and ask questions. I'll give you one more joke at the end anyway. But please ask some questions. Okay, we have a question up here.
Do you find people engaging with you for insurance?
Wait, we have a microphone.
Wondering if you guys have customers reaching out to you just for basic quotes, and maybe they're not only not the best use case, but simplistic stuff, baseline stuff like BCB, DRP, they're not done. No business impact analysis. So what does a customer look like when they come to you in that state?
Yes, so we have customers at all levels of their cybersecurity maturity. One of our goals is, before we go to the cyber insurance carriers, again, we're the broker, we're not the carrier, is to make you look and actually be a good risk. So if you have certain things that we know the carriers are going to struggle with, we're going to work with you on those even before we go to the carriers. We may tell you you have 3 months, 6 months of work to do before you can get cyber insurance. We also have a program called Cyber Pathways, which is meant for companies that have maybe not the best cybersecurity right now, but it gets them an initial cyber insurance policy with the promise that you'll improve over the next year. The carriers are willing to give a policy. You literally sign a contract that says, I'm going to do this, this, and this over the next year, and it gets me a cyber insurance policy. One of the things we see is a lot of companies come to us because as a vendor, you may need a cyber insurance policy. In fact, we don't sign contracts with our vendors unless they have a cyber insurance policy. So a lot of vendors are coming to us, maybe they don't even want to get cyber insurance, but they need to. So they come to us and maybe they're not the best risk. So we have to work with them to become a better risk, but we have something called cyber pathways to help towards that. Any other questions? We have 2 minutes. Oh yeah, we have a question up here.
Yeah, this week we've learned. Thank you so much. This week we learned about couching risk in business context and loss avoidance related to financials. From a security provider's perspective, and maybe you can lend some wisdom as it relates to this, is in extracting that business information from a client in which they might be reluctant to share, right? And so that kind of blows a hole in the couching everything in business context. If the client is not willing to share that information, is there a way to encourage them to do so or quantify it in some form of calculated
So the self-assessment that I've been talking about is, I'm going to say it's mandatory, but it's not really mandatory. So some people will leave questions blank, but we'll go to them and be like, well, look, maybe you're not answering this question because the answer is not favorable, but you're going to get a much better deal on cyber insurance if either you answer it honestly that you do this, or over the next few months or years you work towards doing it. MFA is a great example. At this point, it's very difficult to get cyber insurance if you don't have MFA. It's almost impossible, let's put it that way. So if a company doesn't leave that question, or doesn't answer that question at all, we're maybe not ready to go to the cyber insurance carriers with them just yet. We want to understand what's going on. We have trust between us and our clients. We're obviously under NDA with our clients. We're not going to tell insurance carriers bad things about our clients without the client's permission. Again, just think about our role as a broker. We're helping our client get the cyber insurance. The insurance carriers are our partner, but they're not our client. We want to make sure our client looks best in front of the insurer. So if they leave things blank, we want to understand why the client's doing that and understand it's because they don't know, they need to improve, et cetera. We will work with our clients to make sure that they do the best proper things. Yep. Okay, I'm going to give you a couple more cyber jokes just to leave, and then I'll be done. So I was with actually a cyber insurance underwriter a few weeks ago, and actually coming up on Halloween this month. And he was saying that they're writing a lot of mausoleums all of a sudden as cyber insurance risks. And this is a little bit strange to me, like mausoleums doesn't seem like a great thing for cyber insurers. Why would they be doing this? So I asked the insurance underwriter, why are you all of a sudden excited about mausoleums? And he told me, well, it's because the contents are encrypted at rest. Okay, one last one since I have a couple seconds left. This one's even worse. They only get worse, I promise. So actually, I was with Superman the other day, too. He was trying to get some cyber insurance for I guess, his, I don't know what he does, but he was trying to get cyber insurance. And we were talking about some of the past incidents that Superman has suffered from a cyber perspective. I mean, he can fight bad guys and stuff, but he's not immune from cyber incidents. So he was talking about ransomware attacks that he's suffered over the past year. And I was like, okay, so did you end up paying the ransom to the bad actors? And he said, no, I couldn't because I couldn't touch the cryptocurrency. So with that, thank you very much. Please reach out on LinkedIn or stay in touch. Thank you all.